Your money this week. I've got Andrew back after a little bit of a hiatus, and I do want to explain to our two or three very loyal listeners why we haven't recorded the past 2 weeks. We were just looking forward to getting this started off the ground as soon as we could, and there were predetermined scheduling conflicts, which made it a little bit impractical for us to record the last 2 weeks. But we understand. Saturday, I got a couple of very concerned text messages Saturday afternoon, like, "Hey, what's going on here? Where are the videos?" So I felt
Yeah.
like we just have to address it off the top.
Yeah, I think you have to address it. And again, I would remind people that these are usually posted on Fridays. So if you really cared,
You
check
would
them
have
out.
asked on you would have
Yeah.
asked on Friday, not Saturday. Yeah, that is one of our loyal listeners. Waits a day or two to check in on it, which I don't know how he wraps up his trading week, not knowing what we have to say. So how have you been? You went away to Mexico?
Yeah, went to Mexico. We did a little corporate retreat. It was our firm's 20th anniversary last year. And in true
Nice.
narwhal fashion, rather than do it on the 20th anniversary, we just talked about taking trips and planning them. And then we did it on our 21st anniversary.
I
Uh,
like that.
so, so yeah, about a third of the office went down to Mexico, had a great time. Cool. It was fun getting to, spouses were invited. So getting to know some of those folks a little bit better. And great food, unbelievable food. My kids asked if we went to good Mexican restaurants. And I was like, I think they're just called restaurants when you're in
They
Mexico,
are.
but
Yeah,
it was unbelievable.
that's
So
a dad joke right there for you.
yeah,
But yes,
yeah,
yeah. What and one thing, you're in the kind of intern hideout there where you got a
yeah.
lot of swag behind you. But the thing I don't like about it is bringing our height differential for the first time really into the mix.
Into
Like
focus.
I've tried to adjust my chair. This is about as high as it's going. You're about a foot taller than me to begin with. So here we are. Everybody knows the secret. I've been sitting on booster seats while talking to Andrew. So
Well,
you refuse to be concerned about inflation. And so
yep.
let's just get into it. The market's at an all-time high, and it's not just the US. The global stock market is at an all-time high, but bond yields are pretty high. I mean, I would say the 10-year is close to 4.5, if not at 4.5. Let me just double check because it moved. Yeah, it's 4.568. Um, Oil prices are still elevated, and we had two inflation readings this week, CPI and PPI. And I listen to you guys every morning, you and your investment team. And I feel like when CPI came through, you were, we kind of expected it. Some of these numbers are a little phony. We're heading in the wrong direction. We're eventually going to be heading in the right direction. And then my recap of your PPI conversation was, this one stung a little bit, maybe not as great as we were hoping when you put the two together.
Yes. Yeah. 100%. I mean, I would say, to use the parlance of the morning market briefing, we feel like for the last 18 months, inflation fears have been a little bit over the top. So anytime we've gotten a cool print, meaning a number that's lower than people feared, we've given a shout out to the haters and losers, of which there are many, and noted that they are probably besides themselves. But notably, when PPI came out, I think I said verbatim, the haters and losers, of which there are many, are going to have a field day with this number because it was hot. I mean, it was expected to be hot, but it came in real hot. I would continue to say, as I noted on our last call, I think I was doing it from the hotel room in Charleston.
Yes.
I remain unconcerned on the inflation picture. I told you I refuse to be concerned with it. I refuse to worry about it. It is going to show up more robustly in PPI than CPI because it's a larger component when you think about the actual final demands for goods. So it's going to be a larger component there. Oil obviously remains elevated. In a situation like this, I don't know what the time frame is on the war, and I mean we can get into the war if you want, but I don't have anything new to say about it. This would be the definition, in my opinion, of actual transitory inflation, where the root cause is actually an exogenous event, but it's going to last for a finite period. But the PPI number, my guess, my base case is that is the highest number we are going to see on that, but we're going to continue to see a couple months of elevated numbers.
Can you
CPI on
exp-
the other, yeah.
Can you explain real quickly the difference between the two and why PPI mattered more to you?
Yeah. So when you think about CPI, there's really two factors involved here. So you learn about CPI as your read of inflation in your high school econ class, and they talk about a basket of goods things that are buying. And I don't know about you, Sammy, but as a what year? I was probably 15 when I had my high school econ class. It was literally presented to me as if it were like it was a literal shopping basket of goods. And there is a component of that in which you're looking at food, you're looking at, items like that, but it's also looking at things like food away from home, but it's supposed to represent what people are spending money on. Whereas the producer price index is reflecting how much does it cost to actually get this stuff made? And what is the impact on manufacturing, on making things, on providing services? It's a more, I would argue, a usually a more accurate read. My biggest beef with the consumer price index is number one, the shelter component. Shelter is over 35% of the formula. Now, if you think about a human budget, it would not be outlandish to suggest that 35% of someone's expenses go to shelter. That that I would argue, just on a personal finance side, you may have a different view, but I would argue that might be
No,
on
I, I,
the might be on the
I
high
think that's
side for
right.
some
Yeah.
people, might be on the low side for some people, but like that's a general back of the napkin number that I'm pretty comfortable with. My issue is with how they calculate that, because they don't really look at actual housing transactions. They're not even really necessarily looking directly at rent. They're going around to people and they're saying, hey, how much do you think you could rent your house for? It's called owner's equivalent rent. And it's just not a very accurate number. And it's also by far the largest number in the CPI calculation. So when CPI comes out a little bit warmer than expected, there's some weird nuance on stuff in terms going back to October when there was the government shutdown. We can ignore that. But when you're looking at something and it's saying, hey, 35% of this is shelter, we don't necessarily agree with how shelter is calculated. And it's showing basically shelter costs up 3.3% year over year. That flies in the face of underlying housing data. Not everywhere, every
Sure.
geographic area is different, but we have a historically wide margin between the number of homes for sale and the number of people looking for a house. Supply and demand would indicate to me that that is probably not a strong pricing environment for home sales. We are not seeing rents ratchet up to the extent that they were a couple of years ago, and they're really not ratcheting up at a 3.3% rate on the survey data that we can find on that. So you have a big portion of CPI. The biggest portion we think is really overinflated and out of tune with reality. PPI, on the other hand, when that number comes in hot, we take it a little bit more seriously, and it came in hotter than expected. So it really was kind of two different sides of the story. CPI came out, we just kind of rolled our eyes at it, mostly because of the housing piece. When PPI came out, we take that a lot more seriously, and you're seeing, as you would expect, massive increases month over month, and even on a couple months basis on energy. In March, energy costs were up 10.1%. They were up 7.8% in April. That's when we talk about the durability of this lasting potentially a couple months. That's what we're looking at. And that's where we say, yeah, that probably checks out for manufacturing. People think of oil specifically as gas prices, and that's a really small portion of CPI. But oil goes into just about everything.
Yeah. So I'm just looking at the PPI numbers, and um, where does that take you though in terms of um, your line basically of not being concerned about inflation? I think you said already that you think PPI's clocked its high for the year, and you are more looking at this as transitory Iran
Yep.
conflict. Okay. I've seen stuff that it was trending upwards before the conflict. Now, trending upwards and hot may not be the same thing, but is that not true?
There were pockets that were trending upward. When you look at it though, the upward trend, I think you have to take it within the context of the history of where we've been. It was over call it a trailing 3 month basis. It was trending to where the Fed wants it.
Yeah.
And getting closer to that, kind of hovering in that 2.5 range. So we were heading, I think, in a lot of ways the right direction. I would say that the concerning thing, if you want to freak out about inflation, you shouldn't be freaking out about the CPI. You should freak out about the PPI because it is a leading indicator.
Yeah.
When you think about like what it costs to produce something, usually those costs are then passed through to the consumer, and it shows up in a later CPI figure. So that would be, if you want to ring the fire alarm bell, that's where to look at it. But at the same time, even within this high PPI data point, there's a number of areas in which we're just really not seeing that much movement. We're seeing a lot of movement in transportation, oil
Right.
costs.
Yep.
We're seeing a lot of movement, obviously, in direct energy. The food figure, for instance, not really moving all that much. So for me, I remain unconcerned about inflation. I think we're going to see some upticks here, and we're going to see that in CPI probably a month or two from now. We're going to see this read through there. But I would be surprised if we were talking about this, call it 2 months after the war resolves. Now, when that is, who knows, man?
Yeah. No, I understand. I wouldn't say I want to freak out. It's Friday morning, so I'm definitely not gonna. But
Yeah, yeah. And I didn't mean
I
to imply you were,
no,
but
no, I understand what you're saying. I'm just trying to process how I feel about it. I think it hasn't made its way into wages, which is good, right? So you're not going to get the inflation spiral. I do think there's a clear linkage to energy price increases because of the war. I have heard the shelter argument before, and I understand and believe it. But inflation has remained sticky above their target. I do think that the market is now not pricing in rate cuts. Yields have climbed. So I'm a little bit more apprehensive about it. And I don't like the argument that it's not, and this isn't your argument, that it's, a lot of it is oil and food. And, without that, it wouldn't be so bad. To me, that's like saying without Alabama, Georgia would have the best national, college football program. And these things are just, you cannot make those,
you can't just ignore data
exclusions.
that's bad. Yeah.
Yeah, you can't ignore data like I don't know how many championships since I've been alive, it's been a lot, but I see you're representing one of the ones we didn't win on your t-shirt.
Yeah. I
Yeah.
mean, if there's any first graders out there that they don't know about Alabama championships,
No.
but you do.
It's been a it's been a rough stretch. As a Boston sports fan who's picked up Alabama football, it's been a bad combo, to be
It
clear.
has.
Yeah, I think I give good financial guidance. I have not given good sports fandom guidance. And shout
This
out
is
to our
can I give you a random question? And I truly don't have an opinion on this,
yeah, of
but
course.
I mentioned high school economics class. When I was in high school and even in college, econ professors, teachers, whatever, they talked about like the historical run rate of inflation being 3%. That was just
Yeah,
the round number they used. Well, now we say it's two. I
correct.
find both of those numbers quite arbitrary, but notably, it's harder to get down to two than it is down to three. And I wonder, we have a new Fed chair. We've got Worst coming in. I wonder at some point if the messaging on that doesn't shift. Now, if it does, I'm sure there will be reaction to it, and it may even be political reaction. But I don't know that three is wrong. I don't know that it's right. Same with the 2%. I don't know if you have a thought on that.
Yeah, it's great. And you must have gone to a much better high school than I do. I did not take
I promise I did not.
okay. Well, I didn't take econ in high school. I think I learned like not to rack up credit card debt for a week or two in 12th grade. I found the 2% target to be an odd thing, and I had always been waiting for them to move the goalposts. And I think that a lot of the 2% target fixation came out of when inflation was running below
Yeah.
and they were
Yeah. We
trying to
couldn't
heat
get it.
up. They
Yeah.
couldn't get it there. And so, do I think there's this, massive catastrophe if we're running closer to three than two? Obviously not, because we've done well with inflation above two for a while until it really got, nutty a few years ago.
Hmm.
So yeah, I'm more thinking, well, now it's 3.8 and we had a hot PPI number. And I know that Americans do not like high gas prices. I know that consumers make choices when we have high gas prices. We are fine call on, May, spring, summer road trips right now. It's noticeable at the pump. Does that filter its way into a consumer driven economy or not? That's what we're on the lookout for, which kind of tees us up for the next topic because a few weeks ago when we answered a listener question about why the market wasn't doing worse, you you took me by surprise. I'm new to this whole YouTube thing. I wasn't able to react on the fly and get you going, so I circled back like 4 weeks later. Your question was more, well, I don't understand why the market's not up more. So the floor is yours.
Yeah, I would continue to say, I mean, for us, and a lot of this is going to come down to worldview. We primarily play in the U.S. market, overwhelmingly so, not slightly more U.S., but overwhelmingly so. And we're really a little bit more traditional stock pickers and looking at actual underlying company performance. And for us, I mean, the two big things in play that we have seen through earnings season. I think the poor operators, there's certainly exceptions to everything I'm about to say, but I think the poor operators have struggled a little bit. But companies that we view that have good management teams and effective strategies and real clarity have done a pretty good job of navigating these circumstances, and the frequency with which we've seen positive earnings performance, a beat, and the frequency with which we've seen that paired up with a raise in guidance, or at least commentary that implies, hey, we're not overwhelmed by uncertainty, has suggested to me that we're in a pretty good spot. And then when you combine that with economic survey data, whether it's ISM manufacturing, things that we look at as kind of harbingers of where the economy is going, it's been a favorable backdrop. Now, obviously, the PPI picture that came out Tuesday, Wednesday this week, that changes things, that shifts some things. But from an underlying company performance level, I actually think a lot of companies have done really well, and some of those that have done most poorly have been, we would argue, disproportionately beat up by AI fears and things like that, where there's a real story. And I'm not saying the company shouldn't be down, but I would argue that there's been a bit of overreaction. So when you merge that, where, hey, a lot of companies are doing well, some are getting beat up too much than it should be. And then you say, hey, year to date, the S&P's up about 8%. As of today, market's down today pretty sharply. I'd say we could be up more. And I continue to think that as you think about the rate environment, the 10-year now kind of hovering at around 4.5, 4.6, very elevated. What's interesting to me is if you go back to when was the last time we saw these levels, and I'm paraphrasing, but also looking at the chart. We talked about this morning on the morning market briefing. We really were kind of at this level April 7th of last year, basically at Liberation Day. I would not argue personally that there's more uncertainty now than there was then. I wouldn't suggest that there's as much uncertainty right now as there was then. So to have more clarity and see the 10-year trading at that level suggests that, man, the sell-off we've had in bonds is pretty outsized. And that becomes a very attractive position. So although I would argue that stocks should be higher, within portfolios, we're trimming equity exposure and rolling into bonds. I mean, this is a great time to be buying.
So I do want to get to bonds next, but importantly, on your stock corporate earnings outlook, you're hearing good guidance as well, good forward guidance, not
Yep.
just good numbers.
Yep.
And that's important because I do feel like any rational analysis of why is the market doing well, besides what we talked about last time, which, hey, it kind of always does well, except for the short periods of time when it doesn't, is earnings. Earnings are very
Yep.
strong. And so forward guidance being strong as well. Because I think if the earning picture softens, I think that could, turn into a little bit of now there's really nothing underpinning, this
Yep.
this this rally. I have a trivia question for you.
Okay.
What this is since 1957 when the S&P 500 reconstituted. Three trivia questions. What
Okay.
percent of years do you think were positive?
Oh, 90 ish, 90%.
78%.
Really? I would
Um,
have thought higher.
well, that's why it's a trivia question. If you want me to delete this later, if you don't get the
No.
next two right, I wouldn't. I'll definitely preserve your record and your integrity. Average return in the positive years,
Oh, average return in positive years. I'm going to go 17%.
19%. Pretty good. All right, and then this is my favorite one. I think percent of trading days where the market is within 10% of its all-time high.
Ooh, gosh, man.
I was way off on this one, by the way, so I'm just giving you a little bit of
Um, 63.
wow, 62. Gee,
Well,
man.
people, I mean, I felt like it was going to be more than half. There's a very common, and I get why people think this way, but often you'll hear like, I don't know if we should be buying. We're close to all time highs, and it's like, well, guess what? If we're never close to all time highs, you should never buy.
Yeah, and 50% of the time, by the way, we're in within 5% of all-time high. So basically, that's why I kind of ran these numbers. It was,
That's super interesting.
in a prior bull market, we were answering the question of, hey, is this the right time to buy? We're really close to all-time highs. And I
Yeah.
thought, well, the chart goes like this. I wonder what percent of the time we actually are,
Yeah.
that close. So, just a little bit of trivia
That's good framing,
market.
though. I like that.
Yeah, and I would say if sentiment is any indicator, by the way, the wrap up stocks, we're not in a euphoric environment
No.
right now. I am answering the question of why aren't things worse, much more than why do you own anything else besides stocks in my.
Yep. Can I give you one stock, one earnings call that I think people should pay attention to?
Yeah, absolutely.
So next week, Home Depot reports, and I can't remember if I've mentioned this to you, Sammy, either in conversation or on this call. But Home Depot 2 quarters ago came out, and I thought this was really effective management. But they came out and essentially gave loose guidance for two different scenarios. Home Depot, as you would imagine, incredibly tied to the housing environment. And they basically gave out guidance that layer one was this is if things go the way they currently are and the way we think they will. And that was a bad housing picture.
Okay.
Guidance two was here's if things normalize. Normally, when you hear a company talk about here's if things normalize, oftentimes they're talking about things falling back into place, some mean reversion in which this won't stay this way forever. Home Depot was referring to normalization 6 months ago on the housing side and their business specifically as if we could get back up to normalization, here's what we could see happening for us. But they gave two tracks of guidance 2 quarters ago. They report, I think, on Tuesday of this upcoming week, so 3 or 4 days from now. I'm very curious to see where they're falling within the realm of those two stages of guidance, because to 2 points that I've discussed with two kind of different narratives. One is we've been generally pleased with the performance and the guidance of a lot of the companies that we look closely at and that we cover. In the interest of transparency, we do own Home Depot stock. I expect that they are going to be benchmarking to the more bleak housing picture. And I think that's a bit of a read through on the second topic we talked about earlier, which is just housing and, kind of the contrast between what CPI suggests and what the picture actually looks like. So I think that's the NVIDIA reports next week. Everybody will be talking about that. I think Home Depot is more interesting to follow.
So can you walk us through how it goes next Friday?
Yeah,
Or how?
would love to.
Yeah.
Yeah.
All right. Awesome. And I love that. And I was just thinking through, what you were saying, reminded me. I shared something in my Wednesday reading list about, in any other environment, the housing market being as weak as it is would be recessionary. And why isn't it? And a lot of it was AI and different things. So I do feel like that Home Depot earnings report would be good to understand. And if anybody, didn't see the Wednesday reading list this week, there's a really good article about why residential real estate hasn't hurt the economy yet, even though, by all measures.
Hey, you just went mute. Can you
Did
hear
I
me?
lose you?
Oh,
Yeah.
you're back. You're back.
When did I lose you?
Right after there's an article about why it hasn't turned the economy south, even though by all indications it's looking weak.
All right, sweet. So I want to turn to you about bonds because, we've talked about this before, but as a reminder, my firm's investment approach is asset allocation based. You guys also obviously have to make asset allocation decisions when building a risk profile for clients. So you factor that in, but you're also picking individual securities underneath the hood. That being said, both of our firms have a positive outlook on fixed income, on bonds. And I just wanted to ask, with the potential that rates continue to rise, we don't know that. I know that's not our base case. Is that basically the fact that both of our approaches are, more optimistic on fixed income and even trimming some equities to get into fixed income? Is that an indirect call, at least by our firms jointly, that rates are going to stay range bound here versus continue to tick upwards?
I think so. I think for us, part of it, we're we're not explicitly making a call on the rate environment. I want to be clear on that.
Neither are we,
And
by the
and
way, but
and for
I
us,
feel like we're implicitly making it.
yeah, and I think for us, it's almost a historical probabilistic outcome. I alluded to, economic uncertainty a year ago. I think there's less now. And if I can get paid the same amount on a 10-year treasury as I could a year ago when uncertainty was much higher, I'm going to take that chance. We're going to deploy capital in that realm. And when you go further back, I mean, there was a brief period in 2023 when inflation was incredibly high and proving to be very, very sticky that we were at these levels on the 10-year. But prior to that, I mean, you have to go back a decade plus, really to 2007 to see the 10-year at these levels. So there's also an element of just opportunism where, if we say, hey, the 10 years at 4.5, 4.6, we feel pretty good that given the history and the certainty that we do have, that it's not going to go much higher
Right.
to that range bound point. But there's also an element of, for us on the fixed income side of the portfolio, most of the time, because we're buying individual bonds, we have a very buy and hold approach to it. And so most of the time when we're buying that bond, we're saying, hey, there's going to be a period in the next 10 years where we're pretty glad we're getting 4.6% on this thing. And so that's a big driver for us. The biggest thing I would say structurally that we have shifted some in the last couple of weeks, we don't see much attractive opportunities really on the short end of the curve at all. And so one thing that has changed stylistically is with some clients who are thinking, hey, I might need some cash in 2 years, or, there's a specific cash need coming. Maybe for the last 3 or 4 years, we'd be matching up shorter term treasuries for that. We're actually going pretty hard into long bonds and just saying, look, we're going to clip 5% on this thing. And there might be a little bit of short term volatility in the price, but we're going to get that coupon. We're going to get paid. We're going to move closer and closer to maturity. And in doing so, de-risk. And if you need the cash in 2 years, we're going to decide what we want to sell. Maybe it's this bond, maybe it's stock, maybe it's another bond. But we're being a little bit more opportunistic that way to just lock in more income with the confidence that, hey, there's going to be a period where, yeah, there might be some volatility on the short end, but we're going to trend into more stability on these holdings.
Yeah. So, I mean, you're comfortable with interest rate risk in the portfolio, which
Yep.
I guess is, what both of our firm's outlook is right now. So I've had these random sabbatical observations
Let's go.
that I wanted to share with you. As you've pointed out, I went on sabbatical a month. Oh God, it feels like a month ago, but it was 2 months ago. And a lot of people have asked me, like, what did you do? And there's virtue and entertainment in sleeping a little bit more and not answering emails. So that was the first thing that I did. I went away with Janine, my wife, lovely wife, for a week, which was great. I spent more time, obviously, with my kids, went down to Hilton Head a little bit, tried to work on the golf game. But as I was, making my way through the world, Andrew, I noticed some things that I just don't know where to put these observations. So they're going right at you, right out to the listeners here, all 22 of them. One, have you noticed that they're putting protein into everything right now?
Everything. Protein's hot, man.
It's in drinks, it's in coffee. I saw a commercial for protein laced Pop Tart. Like,
Yeah.
I'm pretty sure the only reason you're not hitting your fitness goals isn't because you're lacking proteins in the Pop Tarts that you're slamming on a daily basis.
And I've got to think that protein into an espresso shot or a coffee, that's got to be bad for productivity, if you know what I mean. I feel like there's going to be some tummy troubles.
Yeah, so that was one. I knew it was everywhere, but I actually didn't really
It
realize it
is
was
everywhere.
everywhere. Yeah, I guess I shouldn't say I knew it was everywhere. I knew it was kind of becoming a thing, but man, once I saw the Pop Tarts and the Dunkin' Donuts drinks at the Starbucks, I thought, what is happening? And then
Yeah.
two, I was spending some time with my lovely daughters, Yasmin and Sienna. Shout out. We were visiting college for the youngest. And at some point, I put a Nickelback song on because I was tired of listening to Noah Khan because there's only so much of that you could ever do in your life. And they got grumpy and they said that I was listening to divorced dad rock.
Ooh.
Did you know that this is a thing?
I didn't know that category specifically. I know that Nickelback, I think they're on the precipice of being so disliked that they actually become liked again.
I
Like,
don't mind listening to them if I have to clean the palate from Noah Khan. So I said, well, this is ridiculous. I love your mom. I'm not going anywhere. We're not.
who else is
What are
in
you
the
talking
divorced
about?
dad rock genre?
So, by the way, there is. So, if you go into Spotify, so I challenged them. I opened up Spotify. There's umpteen divorced dad rock playlists. And by the way, it's all great music most of us like. So, this is very disconcerting.
I'm seeing, so I just pulled it up. We've got a little Three Doors Down.
Yeah.
Now, I will say Papa Roach, questionable in terms of good music.
Well, yeah, I get it.
But you can't
But
win them all.
you put that. Let me tell you this: you put that playlist on at your next cookout. Your people will be like, "Oh, Andrew's got some normal, decent music." So,
Yeah,
divorced dad rock now is a thing created by people 15 to 20 years younger to make fun of
yeah.
my musical taste.
Of just people that like classic hits.
It's tough. It's a tough
It's just
act, but
jealousy,
I'm gonna
jealousy.
live it. If you're bringing us Noah Khan, I'll listen to divorced dad rock every day of my life. All right. With that, I will let you get back to work and make sure you take a lot of notes on Home Depot.
I'll do
Check
it.
out Andrew and his team at Narwhal on the Morning Market Podcast. Please like the video, subscribe to the channel so that more people can learn about divorced dad rock and protein in drinks.
Got to do it.
Got to do it.